Automaker Tata Motors saw a downtick in both the top as well as bottom line. PAT for the quarter has gone down by 22% on a year-on-year basis. Margins also narrowed to 11.6% in quarter two. Both on the commercial vehicles and the passenger vehicles side, the revenues were also down 13% and 3.9% respectively. Abhishek Gaushande, Deputy Vice President Research at Sher Khan by BNP Paribas, is here, joins us. Hi. Abhishek, thanks for joining us. First off, your thoughts on the numbers overall, and tell us what can we expect for the auto sector overall as well, and that comparable to the Tata Motors earnings.
See, broadly, if you talk about this quarter earning in the Tata Motors, so it was anticipated that it would be relatively weak, mainly on the count of the JLR's production constraint. That company has already been guided in a earlier quarter one's con call that it would have a production constraint due to the aluminum, due to the issues at the aluminum suppliers. So that has been reflected and that has been well communicated by the company and it is known. So because of that, we are seeing some kind of a weakness in its numbers. But post that, the company has so far maintained its guidance of around revenue guidance for JLR of around 30 billion pound, and considering that it did around 14 billion pound kind of revenue in the first quarter, and it is expecting a sharp revival in the production and the volumes in a quarter H2 of FY25. So the shortfall, whatever we will see in the quarter two, that would be managed in the next two quarters. So H2 is expected to be better than that of the H1 of FY25. So that is there. Second thing is that in the CV segment, the overall it is a weakness in the industry, and that has been reflected in its performance. But somehow the margins have been maintained. So here we need a guidance from the company that what kind of outlook it is sharing in the coming two quarters. And on the PV side, whatever be the industry performance is there, that would reflect in its performance. So net, what I can say that this kind of a performance was quite anticipated. There's no major surprise in that, other than that marginal increase in this net automotive debt, which I believe is a reflection of muted performance at the JLR. And so far the company has maintained its guidance on the net automotive debt also, that it would be net automotive debt free by the year end. Now, so in that case, what I can say that it's more of a management's confidence, not on the commentary, but the confidence for H2 FY25 that would have a more impact on its stock price performance than the mere numbers.
Right, you've touched upon JLR numbers as well as, near term, we could see some sort of revival as well. The company has been cautious about a bit of a slowdown. Now, what I'm seeing here is that the festive demand, of course, should have aided in the last couple of months of this year. But do you think in the coming months we could see higher discounts to push some sort of sales there?
See, what is happening that if you're talking about the Indian business, I suppose, so especially the PV business now, what is happening that in October month, the overall wholesales is quite somehow equal to that of a retail. It means the inventory build-up, inventory days or the inventory build-up behind before the festive season is and the inventories after the festive season is somehow in the equal range. So how it would impact in the next 2 months is that obviously that in the retail would not be the same as that of the case was during the festive season in the next 2 months. So obviously the wholesale volumes would come down in the coming 2 quarters, and that's why most of the OEMs are giving or the auto ancillary players are talking about a muted volume guidance for PV industry for FY25 and expecting a revival from the FY26. Somehow in the Jan, Feb, March, because of the some seasonality, the volumes would come back, but it would largely manage the shortfall only. So materially, we are not expecting a significant upsurge in a PV industry in H2. More or less, H2 will remain same as that what was in the H1. In the CV side, it will all depend on how the quarter four will play out, because quarter four used to be a seasonally strong quarter for CVs. If the government spending or the infra spending would increase, then it would have some positive impact on the CV segment in the quarter four. But material thing to look out in the CV business is the margin sustainability. So far, OEMs are talking about a double-digit margin, whether it's in Ashok Leyland or Tata Motors. If that would be maintained, then it would be slightly positive. Otherwise, on the volume side, so far H1 was not better as was expected.
If you like this video, then like, share and subscribe to ET Now.